Selling naked put options isn't for everyone. For some, the capital requirements are too high. For others, the risks are too high. And for some, both are too high. Let's bring things back down to earth to learn about a strategy put sellers can use as an alternative: selling what's called a put spread, or a bull put spread as it's also known. Here are a few points to remember when comparing a spread trade to a single leg trade. The spread trade has less potential for profit, but also less risk. The spread trade requires less capital or a lower margin requirement. And because of that lower capital cost, the spread trade has a more favorable break even point. Having a margin account with the appropriate option approval level is also required to trade spreads. Ensure you understand how margin works. And if you're unsure, check out our introductory videos on margin or join a masterclass. Selling a put spread is a bullish strategy, consisting of two option legs. The first leg is a short put, and the second leg is a long put at a lower strike price. Both puts expire on the same day. Let's see how selling a put spread works through an example with our option seller Sarah. Note that this example does not include commissions or other fees. Make sure you're aware of your broker's fee schedule before trading options. Sarah thinks shares of ABC One Corp will stay above $50 for the next 30 days. She could decide to sell a naked put at the $50 strike for $4 to try to profit from this expectation. The contract has a multiplier of 100, so Sarah's maximum profit potential would be $400. Her maximum risk happens when the stock goes to zero. That's a drop of $50. However, Sarah received a premium of $4 when she sold the put. So, her maximum risk is actually $46, for a total of $4,600. Her break-even point would also be $46, the strike price of $50 minus the premium of $4. And her margin requirement would typically be 30% of the $5,000 the option controls, or $1,500. Now let's look at how selling a put spread will work out for Sarah instead. She can sell the same $50 put for $4 and buy a $45 put for $2 to lower the risk and cost of the trade. That makes her net credit $2 and her total premium received $200. And because she sold the spread, that premium received is also her maximum profit. The first step to determining her maximum risk is to find the difference between the two strike prices. In this example, it's $5. This is also known as the width of the spread. Since the width of the spread is $5, Sarah's maximum risk is $5 multiplied by the 100 shares included in the option. So that's $500 minus the $200 premium she received for a total of $300. Calculating the break-even is also a little more involved with the put spread. Because the spread Sarah sold is made up of puts, we subtract the net credit she received from the higher strike price within the spread. That's $50 minus $2 for a break-even point of $48 per share. The last piece is the margin requirement for the spread trade. And we already did the legwork for that. The margin requirement for selling a spread is the width of the spread times the multiplier, which is usually 100. So Sarah's margin requirement on the put spread is the $5 width multiplied by 100, for a total of $500. Here's how the two strategies compare in terms of maximum profit, maximum risk, break-even point, and margin requirement. The single leg trade has a maximum profit of $400 versus the spread trade, which has a maximum profit of $200. The break-even point of the single leg trade is $46, but the break-even point of the spread trade is $48. They're looking similar so far, but here's the kicker. Consider the maximum risk. The maximum loss for the single leg trade is $4,600, compared to just $300 for the spread trade. Another clear difference is the margin required for each strategy. It's $1,500 to sell the naked put compared to $500 for the spread trade. Now, an important point to note is that the maximum risk is only limited while the spread is intact. For example, if ABC One Corp shares sit between $50 and $45 at expiration, Sarah will end up long the stock upon assignment. Her risk potential will then be more than $300 and require a much higher margin to take on the stock position. In general, a put spread trade offers a lower profit potential but has limited risk, lower capital cost or margin requirement, and a lower break-even point. So which strategy is best? As always, Trading strategies are not one size fits all. Sarah's risk tolerance, account funding, and confidence in her expectation of the underlying stock's price movement create a unique situation. She'll have to weigh those considerations to decide which strategy makes the most sense for her. Let's recap what we've learned about selling a put spread. It can also be referred to as a bull put spread. The strategy is made up of two option legs with puts. The first leg is a short put, and the other is a long put with a lower strike price. Traders want the underlying to stay above the strike price of the put they sell. Their maximum profit is the net premium they receive. Their maximum risk is limited to the spread between the strike prices minus the net credit received. Their break-even point is the strike price of the short put minus the net credit received. And the margin requirement for each contract traded is the width of the spread times the multiplier, which is usually 100. So next time you hear someone say the risks associated with selling naked options are too high, give them the lowdown on the spread trading wisdom you just learned.